Take Currie's definition of a discussant as being someone, in my definition, someone that facilitates conversation through argument. So I'll be taking the fundamentalist's point of view on all of this. I think the valuations that we're seeing at the fundamental level, I'm not going to discuss. I'll never argue with Wayne, and never on the listed sector. But the question we're raising that's coming through for us on the fundamental side is whether those growth, the base rental growths, are sustainable. So all of the evaluations that you've seen on the listed sector talk to a continued growth rate, or rental growth, or an income growth rate, or earnings growth, sustainable through the next period. And the question we're asking, given what you've heard on the economic side, given what you've heard in retail, which is a large portion of the institutional investors' portfolio, we're asking whether everyone is in agreement on the base rental growth. So how much of that capital growth, or that growth that's coming through, is due to a valuer's assessment or preference for the retail component, and how much of that earnings growth for us is sustainable? So I would question the valuation at a fundamental level. I still think that there's a couple of things lurking in the closet that haven't come through, and I don't think the values are reflected. It's a personal perspective, so I'm not going to understand it. Excuse the language, crap himself for me saying that in the public forum. That's my view of valuation.
And do you see the 7% growth in the sector that everyone's referring to as what base rental growth will be sustainable on that period, the same period going forward?
You know, it's interesting because I'm constantly surprised by the escalations that are coming through. Let's separate the two forms. There's base rental growth for us is the absolute number of base rental over the capital value, you know, how fast that's growing. And we're not seeing 7 or 8% in any of the sectors at a base rental growth. And if you take the base rental as your major driver of capital growth, then the question has to be, well, where's the rest of it coming from? And is that in the yield shift? So we'll have to see what happens this year. I think it's going to reflect this year on the base rental numbers. I think that you are finding people starting to fight over tenants. And as soon as you start fighting over tenants, you start looking at some reversions that come through a little bit more realistically than maybe
Thanks. That's certainly an interesting perspective, as valuations underpin the asset allocation decision in the end. Wayne, you said that in the non-equity portfolio, you believe that, or a non-equity portfolio should be about 30% of your overall portfolio. How much of that do you see being invested in property? And I want you to just be a little bit more specific between listed property companies, listed property funds, as in Evans Cup portfolios, and direct property unlisted exposure.
The discussion between listed and unlisted is actually quite simple. If you can't get gearing, if you can't take loans against your property, it's a bad asset. So, you know, any direct property where you can't gear it will never give you the same return as a listed property. I don't know the exact numbers, maybe given those are better than but a significant portion of your total return on property or your distribution is because of gearing. Because your cost of capital is lower than the return you get in the property, so you've got to get. So all the big life company portfolios, life companies by law can't borrow against assets. So life company direct property, which makes up an enormous proportion of the unlisted or direct property index, you can't gear it, so you can't compare that to a listed. So I would only really select listed property because without gearing, the good characteristics of property are severely diminished. Of the 30% that I would have in non-shares, you've got to have something cash, you've got to have something equity, so maybe that's 5 or 10%. And I suppose you've got to have some bonds, otherwise you don't get enough diversification. But I would say listed property can easily be 10 to 15% of your portfolio.
And that's in either listed property companies specifically, or
in a
multi-manager.
As long as you've got the gearing, it doesn't really matter.
I guess direct, I fundamentally believe that direct property is not a bad investment. I think we see returns out of direct properties, and you don't get the volatility that come with gearing, but that is a different topic. Liquidity seems to be also a big impact on asset allocation decisions. Even you've spoken about liquidity in the sector, but from what we see is that liquidity doesn't sit through all the stocks. That it's probably the top 5 that give you good liquidity, and then a little bit after that. What's your view on that?
It also depends how big your funds are. We've got an inherent belief that in-house Sesfikile will cap ourselves out to 5% of the sector. The reason being is that I can trade anything that depends on the size of it. So the reality about the size of our funds, I can probably go down to the first 15 stocks. It's really depending on the size you want to trade through. So growth point, you can trade 100 million a day with relative ease. Whereas if you go to the likes of Amelia, it's a little bit harder, you probably trade 20 or push. And then if you go to some of the smaller caps, Currie, for example, you'll struggle to a significant position for our price.
So do you think that fundamentally determines how much of 10 to 15% the asset allocation or the SAAs take into their portfolios?
That's a great question, because it has impacted. It shouldn't, but it has. And that's an amazing thing, is you see some of the bigger houses, for example, and not to take a turn, a great house, but Alan Gray historically have been so big, and their balanced fund managers, if they want to take a 5% or a 10% stake into property, they're going to have liquidity issues. They're not going to pick necessarily the best stock, but they're just going to get more exposure to a redefinable growth rate. So, as I said, the size of your inherent money that you needed to push into the sector is the limiting factor. Not really so much the actual stocks.
We haven't spoken much about Africa today, but I'm quite interested to hear, perhaps Wayne, from you. Do you think that in the considerations to allocate towards property, Africa property is something that will become a bigger play, and specifically given the large private equity nature of a large number of the property funds in Africa? There's an emergence of some income funds, but they're not many.
Look, certainly in the non-private equity funds and the big life company funds and some of the big listed property funds, Africa is becoming a lot more. Look, it's still very small. Understand the Africa component, and certainly the amount of development that we've done in Africa is still minute in comparison to the asset base in South Africa, but it's getting bigger. Certainly, you've seen quite a few proposals done over our desks about doing either office blocks or shopping centres in Africa, and certainly there's a lot more interest. Maybe for South African companies who have their branches in other parts of Africa, so it's actually quite attractive, because you get essentially a South African lease, it's subject to South African control. So I think it will be a prominent part of portfolios, maybe a little more into the future, 5 years, maybe 10 years time. But I mean, Africa outside of South Africa is where the growth is, so eventually the property development growth will also come from that area.
Mario, I was wondering, actually, we're talking about ESG and specifically how the rest of the world view Africa. So as companies move onto the continent, ESG is certainly an important consideration, but it is a lot more difficult than the evidence that you've seen here from ESG in South Africa. Do you think international investors see ESG as a binary issue, so it's either yes or no, or does it influence the size of investment that they make, the percentage allocation to property?
I see in not only in Africa, but in Africa, but in emerging markets, that ESG is that additional factor, risk factor, that is being considered in terms of asset allocation. And you can see this trend that started probably in 2006 with the United Nations Principle on Responsible Investment. at that time, their signatories had something like $4 trillion. And now the assets under the assets under management of signatories of the UNPRI represent something like $44 trillion. So that definitely implies that the asset allocation made under those principles cascade not only in developed markets but also in emerging markets, and also in debt instruments. For example, in green bonds that are meant for projects that have specific environmental and social features, for which energy efficiency retrofits is a substantial part of these green bonds. And companies that do not have a minimum threshold do not qualify to be a green bond. So my perception is yes, that these additional risk factors are now being integrated to a wider range of investment factors that contribute to that investment decision.
Well, do you have a view on that from the work that you've done?
I think it's interesting to see the South African market catching on and how quickly we catch up. One of the things that may not have come through from Mario's presentation was that we may not have a lot of green certified buildings yet compared to other countries, but we have been fast adopters of things like green leases and commercial agreements. So when we see things that we like as South Africans, I think we move pretty quickly. And what we've seen in the last few days, taking Mario around some of the big asset allocators, big asset owners, is that they are definitely starting to look at this stuff. So they're starting to say, I don't think it's a binary decision. I think they're willing to take a graded view. And I do think that if not this year, potentially next year, the year after, you're going to see capital taps being squeezed tighter for those that aren't getting good ratings on the ESG side, where the risks are becoming a little bit more obvious, where they've got portfolios that largely can't be future-proofed or are going to cost too much to retrofit. And you're going to see the taps being turned on slightly easier for those companies that need it. Mario's English is understandably not as good as my own, but he quite clearly articulated that there are some companies in every market, some companies that get it, and some companies that don't. And I do believe that you're going to see a graded flow of capital into those that get it and those that don't. So I don't think it's binary.
I want to bring that back to the valuation discussion that we had earlier. In a way, what do you think the impact of that will be on the underlying valuations, and how do you see that move over the next couple of years?
Generally, these developments are more evolutionary than revolutionary. So I don't think it's really immediate practice whether a particular one, a particular portfolio, a listed portfolio, actually is perceived to be lagging a bit behind on the goals and the percentage of the portfolio. But obviously, over time, what's going to happen is tenants are going to demand it, so you're going to have to stop to actually supply to the tenants. But I don't think there'll be immediate impact on the actual valuation of the sector or of any particular fund sector.
I think it's going to be as defensive as it is going to be offensive. That you're going to need the soil classes of water and lights. You're going to have to fit it out through just to cut costs to get it out of the building. It's not so much being aggressive and increasing the yields, it's actually about giving tenants. And at the moment, with all the spec development in office space, you need to have an edge.
I think there was you in the last couple of days or in the week in the press that spoke about the J253 and that index construction that's of concern to you with the big reliance on the big stocks, and that this index is not as representative. Do you want to just give us a little bit of your thinking on that?
Just a step back, there was Andrew Robbins, but I've got a very contributing thing to it. No, it's liquidity is a blessing as opposed to a curse to these indices. fact that they're bigger and they trade better and they're pretty much more efficient than some of the smaller companies is a great thing. There's no issue there. If you look globally, for many years, if you look at Europe, you get Unibar and Danco is dominating the sector, not more than the likes of the Growthpoint. Go to Australia, it's historically been the likes of Westfield and Stockton. In the States, you've got the likes of Simon Group dominating that sector. So personally, I like the fact that we have certain bigger stocks. And if you want to, that's maybe a personal thing on his side, that if you want to beat the index, don't blame the index, just beat it. Have a go there, and the fact that two bigger stocks are more heavily weighted, then it's easier to beat the index if you don't think the price asset that you spend time.
Wayne, how do you see the role of passives in this property? There's a few of them emerging at the moment, and it's an interesting discussion.
I think investments are the overwhelming majority in my opinion. And this debate of active versus passive has been raging on for decades and decades. And first of all, as an overall comment, as long as you say it hardly matters whether you active or passive. So rather just don't worry about should I be active or passive, just say so on the other side. I see nothing wrong with passive investments. I see nothing wrong with it all the time. The average return of the average asset manager must be less than the passive index because their costs involved. Because the active managers altogether will add up to the index because that is the index. And active managers charge more than passive managers. And so on an after-tax basis, active should give you less than passive. So in theory, passive management is much nicer. But lucky enough for the active managers like myself, people are human, lucky for us. So they don't want to go to the golf course to say, I've got the Satrix 14 looking after my funds every day. They want to say, I've got whoever, John Bickard, Pitfield, whoever, they are sweating 18 hours a day looking after my best interests. And in another way of looking at it, the active management, the active asset management industry has been around for a millennium. And it's not about to disappear and take it over by passive. But personally, there's nothing wrong with investing on a passive basis.
Can I step in there as well? Speaking, you just said general passive versus active, and when they say passive, they mean index trackers. There is no index tracker in the property space. There is no ETF in the same lines of those Satrix that you get as well. And time again, I know in my history in the last 12 years, I've seen guys come in with trackers and they strangely enough convert to something which is an enhanced tracker or not so much a tracker, or they change the structure. Because of the lack of liquidity in some of the stocks, and the high reinvestment rate. Remember, we pay, that depends where you are on the cycle, but for it to say 7 to 8% in distributions, and you've got to find that to reinvest in the liquid markets, we find they not generally, they always underperform over any significant point in time. They underperform the benchmark. So I've heard this story many times. I don't believe it in this Latin context. There is a passive, let's call it a tracker fund in the space.
We're going to end off. I'm going to ask each of you to give me, in your view, the one thing that you think will move the dial for those that make the big asset allocation decisions to up their allocation to property at large. Oh, I'll start by you.
Well, it's easy for me. Transparency. So the big funds providing more information about how their underlying assets are performing, and that then informing the risk-return analysis that the big asset allocators are doing, which will then say to them, this is a separate asset class, this is how it fits into my portfolio, I'm justified through normal risk-return metrics and giving you more money.
Integration, ESG integration of factors that could impact a stakeholder's fund.
Mine's a little bit more technical than it makes it into Wayne's presentation. Is that I think from an asset allocation perspective, historically or even currently, the big pension funds are underweight the sector. And when you start looking at the equity markets, they are looking at price and valuations are looking a little bit toppy. Bonds are still, in my view, more expensive than property, and we don't just want to park your money in cash. I think an asset allocation view, just as an alternative, even though the valuations aren't the best they've ever been, I think there's going to be an adjustment to increase this application of property?
Yeah, and from my side, unfortunately, I think we're going to have to wait. We've got to ride out the higher interest rate cycle, go through a year or two of that first, and unfortunately, I think certainly anything below prime in offices is oversupply. There's lots of vacancies there. Retail seems okay, but maybe a little bit of oversupply. So in other words, I think we've got to wait for economic growth to pick up, and unfortunately, I don't think that's going to happen in the near future. We've got another year or two or a few other things to sort out first. So I don't think there'll be a major allocation in the next 2 years to property by the big pension funds and fund managers.
There's a Hebrew proverb that says, "He is not a full man who does not own a piece of land." So property ownership seems to be a no-brainer. It's your choice where you put it, listed property funds, listed property, direct property. But I believe it remains our chief duty as members of this industry to continue to sell the case for property on an ongoing basis as we go about our daily investment activities. Thank you very much, and thank you.